All right, ladies and gentlemen, welcome once again to another podcast by myself, Si Wing Yi from the Yi Real Estate Network, and our guest host, Mr. Richard Advani, the loan agent from Supreme Lending. And he is not only Mr. Advani, is our primary investment loan agent for our network, but because Richard have been doing this for so long and he's specializing investment loans financing throughout the country, all 50 states for many, many years. So as a result, not only Mr. Avadi getting a lot of financing loan referrals from our investors to buy out-of-state investment properties in different parts of the country, but I have to believe Mr. Advani also received tons of referral clients from other real estate network throughout mostly California, but I suspect he has cultivated additional networking with other investment clubs in other part of the country. So therefore, so anyway, Richard have a very good gig, if you will, is because he have created a awesome machine, awesome business model, and I really appreciate working with him. So today's topic, I'll get to the point, is about, I'm going to ask Richard about his experience with real estate investors as he's doing people's loans, because I have to believe that not only Richard, you provide lending for real estate investors in everywhere in the U.S., but you also, because your client service model is such that you have such a great relationship with those investors, that you are able to do multiple loans with them for long periods of time as investors begin to enhance their portfolio. They come back to you and your team and your great staff to do investment loans over and over and over again, and that they have a happy experience because you guys provide such a good service. Then they refer you their friends, you can do their loans. It just blasts up. I mean, right? So you don't have to say anything. I know you're doing a great job. You're very successful. You're the top 1% of all the loan agents in the country. But with that said, the topic is, let's get to the point. The topic is, I'm going to ask Richard again, some high level, from 10,000 feet level, what is your takeaway from working with many different investors, not just like my network, other investors that you work with, and I like to share with the audience, with our audience, as to what are the some mistakes that are made by investors that use your loan services, and what some of the negativities, some of the some of those mistakes people made. But before you go any further, I don't want to, the 4 formulas I use to help my investors to achieve wealth. I'm going to discuss one of them, okay, for our purpose, because this video is only for about around 30 minutes. Richard, can you see me? I lost your picture.
Yeah, can you not see me?
No.
Okay, bear with me. Is that?
You're back. All right, okay. So I'm going to use one numerical benchmark only for today's presentation. The others, we can talk about it on other podcasts with Mr. Richard Advani. So this one numerical formula, which is critical for investor success, is what I call the rent to value ratio. Okay, let me give you an example. The rent to value ratio should be anywhere from 0.07 to 1%. That's the ratio. That's a benchmark for a positive return. So let me give one example. A very simple example. If someone were to contemplating to buy investment property for $100,000, all they have to do is simply multiply by 1%. So 1% multiplied by 100,000, that equals $1,000 a month of projected monthly rent. That's an ideal situation. Now, it all depends. The practical matter is, it all depends what market and what have you. So, okay, so there are two sort of a investment methodology that investors use for achieving cash flow. One is they buy in the Midwest, and the other model, investors are buying in the South and Southeast. Now, I'll be very brief. The people that want to buy the Midwest, perhaps the people investors looking for high cash flow, right? For example, they can buy, but you know what I mean by Midwest, right? So, Illinois, Indiana, Ohio, upstate New York, or Michigan, or Missouri, or Tennessee. Those places, it's called what we call Midwest type of properties, where the properties are low price. The pricing is around 40,000 to 100,000. You can buy single family home, duplex, fourplex, around that price range, and the rent to value ratio, a little bit above 1%, which presumably you can achieve very high cash flow if that's what investor wants, right? Every investor is different, of course. I mean, so some investors, they like to buy in the South and Southeast, for example, in the United States, like Florida, Texas, Georgia, South Carolina, Alabama, whatever. Some of those, they are more expensive. They are like 150,000 to 200,000, maybe slightly more, but you're not going to get 1%. That's the way it is, right? Rent to value ratio. For example, 150K, if you want to buy new construction, the monthly rent around could be around 1,300. That will give you 0.07, maybe 0.08 or 1%. That's fine. If you want to buy a new construction single family home in the South and Southeast, once again, like 180K, for example, the realistic projected rent is probably around 1,400, maybe 1,450. So that makes it 0.08 of 1%, and you will cash flow with 20 to 25% down onto a single family home product. And finally, some investors are buying new construction, new build, like for 200 to 230K, right? Single family home in South and Southeast. And realistically, the rent you're going to get for 200K, you're probably 1,600, maybe 1,650 per month projected rent. And for 230K product, maybe around 1,800, maybe 1,850. So therefore, 20 to 25% down based on amazing mortgage interest rate of 3.2%, for example, you'll still cash flow pretty nicely. So again, those higher price point, South and Southeast, little bit less cash flow, but more potential for higher appreciation, as opposed to the Midwest, much lower pricing, higher rent to value ratio, sometimes even more than 1%. But those investors, they want high cash flow. They don't really care too much about appreciation. So those are the two business models. So with that in mind, Richard, I think from a high level, you agree with me, right?
Yeah, absolutely. That's a good distinction between the types of markets that are out there, and I think you did a good job of kind of touching on the pros and cons of each. So as Siwing mentioned, I am a real estate investor myself. I have 18 properties across the country, and I get obviously a lot of information from the loan transactions I'm doing. It's almost like insider trading, but yeah. It's nothing that I'm doing is wrong, but it's really amazing because I have that firsthand knowledge of where people are buying, and also their experience in buying those properties gives me a little bit of a competitive advantage, I think, when I go to buy real estate. And I've been very successful in buying properties in a lot of the good markets, for example, that Siwing works with. But at the end of the day, I'm privy and I get to see the appraisals and also get to talk to the clients after the loan is closed, and also get to see those same clients return to buy more properties. And, obviously if someone's bought a couple of properties in the Austin area or in Florida or in upstate New York, and they come back 3 months later to buy a second round of properties, my curiosity is definitely piqued, at least when we first started working with these markets, because, and at that point, generally I'll interview my client who bought those properties on what they liked about the market and what they didn't like. And we're seeing a lot of people I'd say the last 6 to 8 months, but even before that, moving towards, the Austins and, the Central Floridas, just because they offer a good balance of cash flow and appreciation. And, most of the time they're newer homes, but that doesn't mean that, the Buffaloes and the St. Louises and the Indianapolises aren't also good markets. They're just different types of investment. People really look at real estate. It's funny when you look at the stock market, people understand that there's, inherently riskier stocks and, that are going to give you a higher return. And then there's, this more stable stocks like the Johnson and Johnsons and the big historic national companies that may not offer quite as much return, but, they're secure investments. And we know that they're going to generate a good, consistent return. But people don't look at real estate with that same lens most of the time, where they need to. There's different types of investments within real estate that offer different types of returns and different types of comfort levels. To your earlier question, in terms of advice or mistakes I see investors make, it's never about them not buying a good property or a property that is a good investment. It's more of them not having realistic expectations or them not realizing what type of property they're buying. Very oftentimes I run into clients that will buy in a high cash flow area, which is still a good investment. And I own properties in those types of markets as well, but inherently they're going to take a little more work and they're a little bit of an older home. So it's going to be a little bit of a different experience versus buying a brand new construction home in Austin, for example, or in Florida. And where I see people making mistakes, if you want to call it that, is they buy the high cash flow property with the expectation in their head that they're going to have the same, the experience of a B or an A property, and they're not, and I have tons of clients that will only buy that sub $100,000 high cash flow property, and they're very, very successful at it, but they know what they're buying and they know the extra work that may come with it to get those higher returns. And then I have clients who are like, look, I have some clients, and I don't invest this way, but they just want to break even. They want to buy a property in a good market that's going to be, offer long-term growth. And at the end of the day, it's more asset diversification for them and more asset placement than it is almost an investment. They have so much money sitting in the bank earning nothing that they don't mind buying a $400,000 property and putting 50% down to cash flow. But those aren't typically the types of investors that Seawing and I work with, although we welcome those as well. Most of our investors are either looking for, a solid return and solid positive cash flow on a $200,000 to $300,000 new construction property in a strategic market, or they're looking for those higher percentage returns in the Buffaloes and the Clevelands and so forth.
Yeah, very good discussion. Very good answer, Richard. Now, on the other hand, I mean, of course, Richard, you've been part of my network. You've been part of many other much larger real estate investment club, if you will, throughout California, and you work closely with those members as well, not just my club. So you have a lot of good experience and good perspective. But for me, not only newbies, even the so-called savvy real estate investors, from over the years, they come to me, oh, Seawing, how come you're only promoting mainly in South and Southeast and just a little bit of Midwest? How come you don't do Utah or Oregon or California or Arizona? I mean, my frustration is that I do try to educate my investors on a consistent basis, and I shoot out the video and podcast, and I clearly explain my investors, you have to follow the numerical metrics. You have to meet the rent to value ratio, the capitalization rate, which we will talk about in the future podcast, you and I, Richard. We can talk about cash on cash return, the capitalization rate, and the total return on investment. So those are the three numerical metrics. Each of those metrics will take 30 minutes to discuss. So I'm not going to, right? Rich and I don't have the time or the effort to do a 3-hour podcast, right? So we can restrict to a very simple rent to value ratio. Now, some of the mistakes that I found, and Richard, when you do loans with investors over the years, not just in past 1 year, sometimes you're wondering, why is this investor buying this area? Why, when I do the loan for them, I clearly see the numbers just does not match. And some of these investors, they still gonna proceed with it. Let me give you an example. The reason why I do not promote the Western atmosphere of the US, like for example, west of the Mississippi, for example, because those rental properties does not cash flow. The numbers does not work. It does not meet the 1% or almost 1% rent to value ratio. And those areas are, don't get me wrong. I mean, I get all the information from YouTube and other research companies. They say, the top 10, growing market is Seattle or Phoenix or Las Vegas or whatever, and Idaho, Boise. I get it. I understand. I agree. Those markets are very fast growing as well, not just the Midwest, not just the South and Southeast. But I'll tell them, I asked this simple question for those investors. I mean, are those markets meeting the return? Are they meeting the rent to value ratio and all that, the cap rate, all those kind of things? They don't know.
Well, at the end of the day, as you know, Seawing, if the property is not even breaking even or generating any type of cash flow, what is the investment? The investment is very speculative at that point. And in my opinion, those types of speculative investments lost a lot of people money in the last crash in 2007, 2008. And I'm not saying don't invest in high growth areas. You invest in them and you promote them, and I invest in them as well. But you still need to have that front end cash flow component, because appreciation is great. But if you're investing with good fundamentals, appreciation is a bonus, not the basis of your investment. Which, look, Boise, Idaho's blowing up, right? Utah's blowing up. It would have been great if 7, 8 years ago everyone bought there. But when most people, the average person who's not bought real estate, hears about a market, it's just like hearing about a stock, right? By the time it reaches the masses, it's gone already. That opportunity's gone.
Right.
And if you're going to chase that opportunity, you're either A, going to buy a property that doesn't have good fundamentals, doesn't cash flow, or B, you're going to be so desperate to get in that market, and I've seen people do it, that you go to the worst part of Boise, Idaho to find a house that does fit the numbers, and it's not a good investment at that point,
Yeah, exactly. So I know, Richard, you and your team have done, I don't know exactly, but I'm venturing to guess you and your team, you have large staff, you guys do tons of loans, investment loans, and even owner occupied, but we're not going to talk about owner occupied loans.
Typically 350 to 400 investor loans a year.
Tell me some of the horror, hate to use a term, horror stories, some of the loans, investment loans that you have done. And of course, you're not going to mention names, and you don't even need to mention the city. Just some of when you do the loan transaction with that investor, I mean, you're glad to do it because, you get paid to close the loans. But in the back of your mind, as you review the loan transaction, as you do the loan with the investor, you're asking yourself, what is this investor doing? I mean, this, although I can do the loan, I'll be glad to do it. And this investor buying the right place at the right time, with the right rent to value ratio. I mean, it just boggles your mind. Can you give me some horror stories of in the past, in past 5 years, even past 10 years, but just a sample case of what happened?
Yeah, I mean, I definitely have examples on both ends of the spectrum, from people buying $15,000 to $20,000 houses that they did not thoroughly vet. It's one thing to buy a house like that and plan on putting a lot of money into it and getting it up to rent ready standards, but they were under the assumption that they were going to be able to buy it for that $20,000 and that, it was going to perform, and that was it, and that they were going to collect rent. And obviously it didn't prove to end that way. That particular client bought 3 properties, and, speaking to him a year later, he had spent at equal to his down payment on each property already in repairs, right? So, just chasing that paper return. But I think a big problem there too was he wasn't leveraging any type of local experts, right? He wasn't using a group. He wasn't a part of an investment network, nor was he even using an investor-specific realtor. He just went on Zillow and found a realtor and was like, hey, I can skip everyone and I can do it on my own. And it ended up costing him a huge, huge amount of money in the long run. And then the other end of the spectrum, right, that you and I both know, which is someone chasing a market, someone investing in a market after the wave is really passed and, buying a property really that didn't cash flow. And a year, 2 years later, this person who was banking on the appreciation, they did see a little appreciation, although once I actually calculated how much they were running negative every month, it ended up being like $5,000 or $6,000 a property. Their plan was to hold the property even longer, but they ran into an issue where, the homeowners association wasn't allowing investors. And long story short, they had to get rid of these properties. And what people don't really factor as well when they're looking at buying an appreciating property is, on average, to sell a property, it costs 7 to 10% in transactional costs. The realtors, the escrow fees, the title fees. So you may gain 8 to 10% in property value, but it doesn't mean that you're ever going to be able to realize that. You need to realize 30, 40, 50% gains before it even makes sense for you to sell the property when you factor in those closing costs, or even, to refinance the property. So it kind of falls back to what I said earlier. The biggest blunders I've seen people make is not having realistic expectations of what they are buying, thinking they're going to get the beep new construction property type of experience when they're buying, a property that's inferior and much older.
Yeah, exactly. Yeah, that's right. I mean, yeah, again, the benchmark is using leverage. That's the way they come to you, right? I mean, you as a loan agent is such a valuable resource for investors, especially for newbie investors, because I know you got, when I send you a loan prospect, investment loan prospect, I really like your, client service methodology. I mean, you set up a phone appointment with them. Then you take your time, spend 10, 15, 20 minutes over the phone to discuss an investor's goals and objectives. Why you want to buy this property? I mean, what is your expectation? What kind of loan, what kind of down payment, or what kind of numbers do you expect? So when you understand your loan prospects' goals and objectives, you can provide better service and recommend the right loan product, or even make some personal recommendation. Don't do this because the number does not make sense. The market you are buying, you just, I know you heard it from your friend, from your relative, or from your coworker. This is a good place to buy because they bought it, or whatever, because their son is going to college in that city. You should buy there too. I mean, it's just the advice people takes out there. It just they get into so emotionally involved in a buying decision. They don't understand the numerical metrics, the number crunching, the whole overall analysis of a property. So given that, what any of the cases do you have run into that happen like this as well?
I mean, there's a lot of them are very similar, but one thing I'll share is, the reason why C-Wing offers and is as staunch as he is as it relates to the cash flow, and the reason I am, is not because we're super brilliant and smart. It's because we probably made most of those mistakes, right? And we're trying to have other people prevent making those mistakes. The first property I ever bought, it was funny, that example I was using earlier about the $20,000 property. Guess who that was? It was me.
Yeah.
My first property I bought 14, 13 years ago. $22,000 for a duplex, rented out. Both sides were rented out. I thought I was gonna be a millionaire in 3 or 4 years after that. I'm like, I'm gonna buy so many of these $20,000 duplexes, rented at $1,000 a month. Yeah, right. You laugh. Exactly. Now we have the experience. It was silly to think that would be an investment, right? Year 1, year 2, I put so much money into that property. But I didn't have anyone to learn from, and I didn't know of any real estate investment groups. I was 20 years old. I didn't know what I was doing, but it ended up costing me a lot of money making that mistake. And the interesting thing is I have people come to me today with similar scenarios, and I absolutely do tell them, like, hey, wait a minute, I did that. And if you want to do it, it's okay, but make sure you understand what you're getting into, and it's amazing having resources like your group as well, to where people can come in and you can, and we can prevent them from making some of the big mistakes that we've made, but also you can also offer them alternatives that do make sense. You have the property managers and, the markets and everything in between. But I think educating yourself on the markets for an investor is extremely important. And also asking yourself what you want. Everyone's like, wow, I want cash, good return. Okay, good return for what? On a $200,000 property, a 10% return may only be $300 a month. What is that going to do for you? Are you going to put that in your pocket? What is that? Does that mean it's just like a dinner to you? Or are you more interested? Are you in your 40s and you're more interested in trying to pay that house off? That way, 15, 20 years from now, you will be able to collect $1,800 a month from the property, or $2,000 a month. So why is cash flow important? When is cash flow important to you? I think, the return, the rate of return is a good way to evaluate whether a property is a good property or a bad property, but it doesn't need to be the only basis for your investment. And, you need to have a different strategy if you are retiring in 2 or 3 years versus if you're retiring in 25 years. And, if I have some clients who, are about to retire, they have a lot of money in securities, and they don't have enough income coming in. And for those people, buying a higher cash flow property makes a lot of sense, because they're trying to replace an income. Yep. But I can tell you, 80 to 90% of our clients aren't trying to replace an income. That 10 to 12% or $400 in their pocket, they don't even need the money, right? And they spend that on a dinner sometimes, and so they need to look at the investment a little differently, and, potentially look at it in terms of what the property is going to mean for them 15, 20 years down the line. A lot of people buy that first rental property as a college fund for their children. You have a 1-year-old, great time to buy a piece of investment real estate with 20% down, because that $30,000, $40,000 down payment you put, by the time your kid's going to go to college and need that money, you're going to have a near paid off property. It's going to be generating cash flow. You could sell it, and now all of a sudden you have that lump sum to pay for the college education. So there's all kinds of different ways you can use the investments and analyze them. But merely saying, well, I need a property to make this return, isn't a fair way to look at things. It varies from person to person, and what a good investment is varies from person to person, depending on what their needs are and what their goals are.
Exactly. Well, Richard, we only have like 5 minutes left. I mean, we can talk all day, because you and I, it's not a job for us. This is a passion for us. We love helping people. Myself, being a promoter of a real estate investment network, if you will. Yeah, some of you guys are thinking, oh, I'm just trying to sell product. No, I love consulting with my investors. That's been my personality. I love coaching, guiding, mentoring my investors, and I feel a tremendous amount of satisfaction over the years. And how I know, because my investors tells me over the years, see, Wing, oh, you're so quick to respond to my phone calls and emails and texts. I mean, you love to take your time out of your day to coach me, mentor me, understand my goals and objectives and all the challenges. So I take them through the whole long-term relationship. Even though on paper, Richard, you are a investment loan agent, to me and to a lot of your clients that have done loans with you, you are much more than a loan agent. Yes, the loan transaction is the bread and butter what you do, but you are just like me in a way. You try to work with the investors, understand the goals and objectives, and just educate them, help them make an informed decision, and simply use the financing aspect to help them to take where they are right now to where they want to be. But so therefore, credit is so having good credit is so important. Having the ability to leverage, to use financing, to leverage the wealth through multiple loans and 10 mortgages max. We'll talk about that some other time. But 2 minutes left, so go ahead and recap. What are your final thoughts, and we'll be done.
Well, as you said, just the beauty of leverage is something amazing. Interest rates for rentals right now are in the mid 3% range. A year ago, the lowest primary homes had ever been was the mid threes. And fast forward to today, although we all thought, the rates were probably going to go up at some point, they're lower. I mean, mid threes on a rental property. Look, property values have gone up everywhere, even out of state. The only difference is California, I feel like, is capped out. These other markets have a lot to grow, but they have gone up from 2 years ago. Now, does that mean you don't buy? Well, firstly, the rates being 1 to 1.5% lower than they were even a year and a half ago makes up for a lot of that price increase, right? And this is a rare time to still have those low rates, buy these properties that, they may not make sense if the rates are 4.5% or 5%, where they do make sense at 3.5% that they're at today. So that window, although we don't expect rates to go up to 5% tomorrow, that window is shrinking. There's no reason to sit on the fence. Money is as cheap as it's ever been. And it's barely above the inflation rate, the historic inflation rate at least. So, if you're on the fence, now's a good time to get off the fence. People ask me often what I would do, and whether it's a good time to buy. I get asked all the time, and what I would do if properties that if the market turned and next year property values are lower. And the answer is simple. It's the same thing I would do with my stock portfolio, which is dollar cost average. I would buy more next year. It wouldn't freak me out. I would buy more because there's more and more people on this earth every single day, and the land is not growing at all unless you're on the big island of Hawaii. So, to me, it's definitely a good long-term investment. It's cyclical as anything is, but, even with the cycles, it always ends up higher than it did the preceding 10 to 12 years. The only variable typically is rates. Rates are the lowest they've ever been. We know real estate is going to go up in the long term. Historically, it always does. We don't know where rates are going to be, but we do know they're super low right now. So take advantage of it. If anyone has any questions and they're still not quite ready to pull the trigger, don't worry. I'm not going to try to pull your credit when I talk to you. I'm here to have a conversation. I'm here to give you information. That way you can make a comfortable, intelligent decision. But yeah, thank you for another great webinar, and I look forward to many more in the future, Siwing.
Oh, absolutely. We have so many more topics to discuss on a 30-minute podcast module, for foreseeable future, bi-weekly or once a month, even once a week, potentially. There's so many topics that Richard and I can share and, piggyback and forth. So before I let you go, Richard, well said. Can you, although I will provide my numbers with your contact information, can you verbally, before I let you, before we get done, provide the people your contact information, your email, your text, and your website?
Absolutely, yeah. My phone number, firstly, is 949 area code 294-0435. My website is my first and last name.com. So that's Richard Advani, ADVANI.com. And my email address is richard.advani@supremelending.com. Appreciate the opportunity once again. Look forward to helping you guys become real estate investors or grow your portfolio if you are already a real estate investor.
Thank you, Richard. Thank you for your time to take the time so busy out of your day, and we'll be back for future topics to be discussed. Thank you so much, everyone. Have a nice, blessed day. Goodbye.